Go ahead and get started.
Okay, sounds good.
So thank you for joining us this afternoon with Start Smart, financial literacy workshop for teens and young adults. I was thinking about it, and we probably should have called this Start Smart and Stay Smart, because this is actually going to be pertinent to not only teens and young adults just starting out, but the important information that we're going to be giving you today, going through, pertains to really everybody, young adults and adults as well. So it's always good to have a refresher on the information we're going to give today. I'm Deborah Kelly. I am a financial advisor at Potomac Financial Group. I'm a certified financial planner, as well as a chartered federal employee benefits consultant, which basically means that I kind of specialize with working with federal employees.
Thanks, Deb. And I'm Jeremy Dvorak. I'm a certified financial planner also and a chartered advisor for senior living. So my expertise really is mostly in working with people who are retired or approaching retirement. And I couldn't agree with you more, Deb. I know the reason that we decided to put this presentation together is between the two of us, we have a lot of years of meeting with people, and I can literally count on one hand how many times somebody has said to me, you know, Mom or Dad got us started early on saving in our 401k and with good habits. And you know, that's the reason that I'm financially successful. And Deb, I'm sure you'll agree that we probably hear people say, gee, I sure wish I'd have started this 20 years earlier every week. So there's a lot more people out there who didn't get this information early on. And like Deb just said, this isn't something that applies just now in your life, but it's going to apply for the rest of your lives. And we're teaching this stuff to people much older right now. So we'd like you to get started here early with the right information.
Yes, indeed. So similar to what Jeremy was just saying, we're pretty passionate about making sure not only our clients, but people in general are well-versed, educated about finances. And why is it so important? Financial literacy. I'm going to go through a couple of reasons here. The top reason students give for dropping out of college: financial constraints, money, not enough money. Young adults and all adults, I have to say, underestimate the length of time it would take to pay off a credit card balance. It's kind of eye-opening how long it does take. And we're going to address that later on in this webinar. Approximately 6% of college students have more than $5,000 in credit card debt. More than half of US citizens are living paycheck to paycheck. Doesn't matter if you're high income or low income, it's about the same, 56% living paycheck to paycheck. And then only about a third of Americans maintain a household budget, basically know what's coming in and what's going out and try to adhere to that. 21%, nearly a quarter of Americans have absolutely nothing set aside to cover an unexpected emergency, what we would call having an emergency fund in place. And the average 2019 college graduate left school with approximately $30,000 in total debt. That is not a good way to start when you're just getting out of college. That's a lot of debt to try to, pull yourself up from.
Absolutely. So to help with some of those things, today we're going to cover three important fundamentals for creating a successful financial life. And we're going to show you why it's important to start these habits early. The first thing we're going to teach you is how to create a personal budget or a spending plan so you can have control of your finances right from the get-go. Then we're going to teach you how to borrow money responsibly at the right times for the right reasons. And finally, we'll show you why it's important to save a little bit of everything you make and how through compound interest, your money can work for you to make saving easier in the future. And by the end of this class, you'll have three basic but important rules that if you follow, you'll never have to worry about money again as you grow older. So let's get started with the first chapter. So when we use the term budget or budgeting, what we're really talking about is understanding what is happening with our money. It's knowing how much we have coming in and how much we have going out, and being able to make decisions where we can about what we do with our money. And often I tell clients that when you earn money, there's really only three things that can happen to it. You can spend it, you can save it, or you can pay taxes with it. Now, as your parents will surely attest, you don't get much choice about the paying taxes part. So we're not going to go into too much detail about taxes here, but for those of you who haven't gotten to this point yet, When you make money in this country or any other country that I'm aware of, frankly, you have to give some of it to the government. This money goes toward all kinds of things. So a little bit pays to make the roads that we drive on and keep them in good repair. It pays the teachers at your school so everyone can get an education. And it goes toward lots and lots of other things that we couldn't possibly list here. And most people feel they would rather their taxes go to certain things rather than others, but unfortunately, we really don't get to choose. The government tells you how much you're going to have to pay, and while there's many factors that influence your taxes, the very general idea is that the more money you make, the more money you will pay in taxes. It just is what it is. So without getting any more involved in that discussion, just know that of the three possible things that can happen to your money, you can really only control two of them, and that's the spending and the saving. So right now we're going to talk about the spending part. So the idea here is that money comes in, some of it, but hopefully not all of it goes out, and then there should be something left over. And one term for this is a budget, but you can also call it a spending plan, which I like a little better. Budget sounds like we're restricting how much we have to spend, and it's true that we all have to do that in some way. Nobody I know can wake up and literally buy whatever they want every day without having to think about it. So I like the term spending plan a little better because it just means we're taking control of what happens to our money, and we're using our own judgment and choices to get the most out of what we have. So let me walk you through this particular spending plan, which, by the way, we chose specifically for this group because it shows some of the areas many young people are familiar with. And this particular spending plan is for somebody in college, but you can tailor it to your own personal situation. Here at the top, we have what is coming in, which is called our income. And this person has three sources of income. They work a part-time job and they earn about $800 a month. They get some scholarships from school to help with some expenses, and that's about $200 a month. And then their family gives them some money, and that's $150 each month. Now, don't go telling your parents Jeremy and Deb said that they have to give you $150 allowance every month, because I don't think we want to take those kind of phone calls.
No.
That's my first dad joke of the presentation. There could be more.
I'm laughing.
Thanks.
It's a mom joke too.
Thanks. So we can see the total amount of income, or the total money that they have coming in, is $1,150. Now, the next two sections are the expenses. So this is the money that's going out. It's our spending. And as you'll see, there's two types. There's fixed or recurring spending, which happens on a regular basis. And then there's our flexible spending, which might not be the same all the time. In the fixed expenses that happen every month, this person has a cell phone and the bill's $65 a month. They belong to a fraternity, and that's about $250 a month. And to get around campus, they take the bus, and the monthly cost for that is about $50. So again, we can see our total here for our fixed expenses is $365. Under flexible expenses, they have it broken down into 5 categories. They have groceries, restaurants and going out, textbooks, clothing and other, and they have entertainment. And there's many more ways to spend money outside of those categories. We're going to talk about that in a second, but just to illustrate the point, these are the ones that they have in their spending plan, and the total that they spent on the flexible expenses was $650 per month. So then below that, they are choosing to put a certain amount of money each way into 2 types of savings accounts. So one's for emergencies. They don't touch that for any reason at all unless they have a very serious need and they don't have any other money to pay for it. And then there's regular, or what they're calling miscellaneous savings, which is just putting away money for things they may want to buy later or spend money on in the future. Maybe they want to go on a trip with some friends. Maybe they want to move into a new place someday, those kind of things. And that's $50 a month there in total. So now when we get to the bottom, you can see how this flows. So our income comes in, our fixed and flexible expenses go out, and we put some money away in savings, and what is left over is our cushion. So this person has, at the end of the day, $85 left at the end of the month to decide what to do with. They can either spend it on something that they need or want, or they can save it for later. Or the smart thing to do would probably be to spend a little and to save a little. So to put a spending plan like this together, we need to know all of this information. And for most people, the top part, the income's pretty easy. You should have a general idea how much money you have coming in from the various sources, and you can list that here. real quick note about taxes. So most often, if you work a job somewhere, they will take some money out of each of your paychecks and they will send that to the government for you to pay your taxes, called withholding. This can come as a real shock if you're not expecting it. So I still remember my first job that I actually received a paycheck from. I'd worked a couple of weeks. I was supposed to get $600. When I got my check, it was only $450 because of the taxes that were withheld. And I was so mad. I mean, I guess either nobody told me or if they did, I didn't listen, but boy, was I mad.
Still mad.
Yeah, right, sis. Yeah, I haven't forgotten that one. So the point here is not to be upset about it, though. The point is when you figure out your income that you have to spend, you have to use the amount after taxes. So in my example, I wouldn't have put $600 there. I would have put the $450 that I had left over because that's how much I actually had to spend. So now you need to figure out your spending, which can be a lot trickier. So in my opinion, there's two ways to get there. One is try to figure out on your own how much you think you spend on each and every single thing in the world, and then add it all up. As you can imagine, it would be very hard to do this and to know that you actually captured everything. So the other way is just to look at your bank app or website or your credit card. If you're using credit cards, Deb's going to talk about that in a bit, and look at the total amount that you spend and see through the transactions exactly where you're spending it. And then you can take that information and put it into categories like the above. By doing it this way, you know you haven't missed anything, and then it makes it easier to plan for the future. When I do this with clients, I've always found that if people try to add up their own expenses rather than just look at their bank statements and see how much they're actually spending, it always looks like they spend a lot less than they do. And this is because all the things, the little things that we spend money on that we don't pay as much attention to because they aren't as big. So everybody can think about their rent or their mortgage payment and their cell phone bill and so on, but life has a way of making you spend your hard-earned money if you're not paying attention. And these are just a few examples, but in this case, somebody who's making almost $70,000 a year, they could easily spend a quarter of that or more on things that they wouldn't consider to be major expenses. So things like coffee, fast food, gym memberships, and others. Some other common places to spend money are things like Amazon, Spotify, streaming services, gifts for friends, and others. And it can be very tempting to ignore these kinds of expenses because they don't feel like they're as big a deal. And someday down the road, maybe you won't have to be as worried about the little things, but when you're just starting out, every dollar counts. And if you're not careful, you may find yourself struggling to make ends meet, maybe coming up short, or maybe even asking your parents to bail you out. And I'm sure your parents love you and they would do anything to support you, but I also know they want you to have the tools to make smart decisions and to be successful because of your own hard work. Deb's going to talk to you in just a bit about credit cards. And when you begin to use credit, this will be even more important. So do not discount these small expenses. So in addition to using that bank app or website to track your spending, you can also use apps that are specifically doing this for you. So they will break all of the money you have spent into different categories. So here we can see things like food and entertainment and savings and just a variety of other things here, all broken out for you based on your own spending. Now, these apps aren't perfect, so they may not know exactly how to classify your spending. You have to be careful of that. Again, great examples are stores like Amazon and Walmart. It may show you spent $50 at Target as merchandise, but you need to know whether you spent $50 on food and medicine or on something for your apartment or on makeup and video games or what have you. So be sure to pay attention to this as you go. And with those apps, you can typically change the category that an expense falls in if you know what it was spent on. And at the end of the day, the people who are most financially successful give every dollar a job, meaning they know exactly how much they have coming in and they choose what they're going to do with it. Remember, you can only spend it, save it, or pay taxes with it. And you don't get to choose how much you pay in taxes. So you have to be mindful about how much gets spent versus saved. In a little while, we're going to talk about the importance of saving and how to make your money work for you. But for now, I'm going to turn it back to Deb. She's going to talk about how borrowing money works and some pitfalls to avoid.
Thanks, Jeremy. I just noticed that my Potomac Financial Group sign is backwards. It's mirror. I don't know how to switch that. I apologize, everybody. Anyhow, now that Jeremy just went over establishing a budget, your spending plan, let's move on to establishing credit. Now, establishing credit, it's important to have credit. So we already talked about, we want to try to make sure you have enough money to cover all of your expenses, but sometimes you don't. So credit, what is it? It's money you borrow to pay for things. So you're borrowing. Why is it important? It can be useful in emergencies. If you don't have that emergency fund, you have a large expense because of an emergency, you can use credit for that. It's certainly more convenient than carrying a wad of cash. And heck, nowadays, young people don't even carry cash. You use Venmo and everything else, all the other apps, but you can't use Venmo to pay for a car or to pay a big expense. Car dealers are not going to, dealerships are not going to accept Venmo. Restaurants probably don't accept it. Stores don't accept it. So having credit, it's very convenient. Also lets you make large purchases. Not too many people have enough money to go out and buy a home outright. Cars are another thing. A lot of expenses that are quite large, you can buy on credit or using credit. And it can also affect your ability to get employment, housing, and insurance. And that's not something that a lot of people think about, but a lot of companies will look at your credit history and decide whether or not they're going to hire you. If you're going to rent a house, buy a house, they're going to look at it as well. But we'll talk about that in a few minutes. And there are different types of loans you can get. Consumer installment loans. Installment means you pay in installments. So you purchase something, a car, furniture, whatever it might be. You borrow a certain amount of money. They figure out how long that's going to be for, 2 years, 4 years, 5 years, and you pay equal payments every month until you pay that off over those 2, 4, 5 years, whatever it might be. So that's an installment loan. There are credit cards. Credit cards are actually more of a revolving credit. It can change every month, depending on whether you make more purchases, the payments that you make. So it's not a set amount each month. That's revolving credit. Student loans, mortgages, these are some things that you may be familiar with already. And ideally, down the road, you will become more familiar with mortgages on your own. And Jeremy's controlling the slides, so I'm not able to circle. So hopefully you can follow along in some of the later slides that I have. So it's important to establish credit, but credit isn't free. So there are a lot of fees associated with credit. You often have annual maintenance fees. Certainly in credit cards, you tend to have annual maintenance fees, service charges. Those can be on all sorts of different types of loans. And those can add up rather quickly depending on what the service is. And then late fees. And I am going to harp on this throughout this presentation, late fees. Don't pay your bills late because you will be charged late fees. So you're already going to be paying what you're going to see, I'm going to address next, interest, but late fees should be avoided at all costs. But then the biggest expense is the interest. And the interest on credit, it's a fee that you're paying on top of the money you already owe. So you borrow money and you pay the interest, and that's the fee that you're paying for the opportunity to borrow that money. So it's the price paid for borrowing money. Now, we're talking about credit. It is important, it's crucial to borrow responsibly. So we talk about good debt and bad debt. Let's look at the good debt first. Good debt would be mortgages, business loans, student loans. Good debt tends to have lower interest rates, so it's a lower cost for you to have those loans. They tend to help increase your net worth. You buy a house, there's a lot of value to that house. You're gaining equity. A business loan, similar. You're starting a business, that's, there's something down the road. Student loans, getting you a good start. Ideally, it's going to increase your net worth. And good debt often has tax advantages in that mortgages, business loans, student loans, you may be able to write off the interest on those on your taxes. So you might be able to have a tax deduction of the interest rate that you're paying each year. Bad debt, on the other hand, you can't write off. And bad debt would consist of consumer loans, those installment loans, lingering credit card debt that you're just letting hang there. You're not paying it off. It just continues to grow and just isn't going away. And car loans. Bad debt, we call it that because they tend to have higher interest rates on those loans or credit cards. There's no lasting value really. And with good, better budgeting, ideally they could be prevented. Now, it seems a little counterintuitive to say that a car loan would be bad debt because you know it's a big expense. You need to have that. But car loans tend to have higher interest rates, number one. Number two, there's really no lasting value in a car. You drive it off the lot at the dealership, you lose value immediately. So that value isn't lasting like it is in a mortgage. Hence, we call that bad debt. Bad debt. Thank you.
You're welcome.
Okay. So when you establish credit, whether it's credit cards, loans, what have you, there are 3 credit reporting agencies or credit reporting bureaus. There's Equifax, TransUnion, and Experian. So the 3 of those companies, and what they do is they pull together all of your credit history, all your credit information, and they compile reports. And those reports are used by lenders. So if you want to try to borrow money, the lender is going to contact those credit reporting agencies and request a report on you. And they're going to look at that report and they're going to decide based on that report what your credit worthiness is. Should they give you a loan? Should they give you a credit card? And if they do, how much should they give you and at what interest rate? So the information on those credit reports is it's very important. It will determine whether you get a loan or another form of credit, as I just mentioned, get a job. In our industry, and I know for clearance for a lot of companies and jobs, government, in order for you to be cleared for a job, again, to work in my industry, they're going to check your credit report. They need to know that you're not just financially creditworthy, but that's kind of a reflection on you in general. If you pay your bills, if you take care of what you're fiscally responsible for, the assumption is that you're responsible in other areas of your life as well. If you cannot be financially responsible, that says a lot about you, and you might be rejected from getting a job. Renting an apartment, they're going to use that credit report. Why would they want to rent to somebody who doesn't pay their bills? So you might not be able to rent an apartment. Get insurance, get utilities, the same thing. Get cell phone service. Many of you right now are probably on your parents' cell phone plan. What happens if a few years from now, your parents are like, you got to get your own plan, but you haven't established credit or you've established poor credit. Your credit report is very negative. You're not getting cell phone service. They're not going to put you on a plan if you have bad credit. So it's really important. So many different aspects of your life are going to depend on this credit report. So be smart about it. So another thing that those credit reporting agencies do, they assign you a Fico score, is what we call it, Fico grading system they each have. So they're going to assign you a score based on their reports. And in that report, I should have mentioned, it has your payment history. It will say how often you've been late on payments, when you establish credit. It really goes in, it takes a deep dive into your credit history. And you can get free copies of your credit reports. And I would encourage you to do that from those 3 credit reporting agencies. You're eligible to do so once a year from each of those. So the 3 different companies, you know, maybe every quarter of the year, you reach out to one of the different ones and get your credit report. But again, they come up with a grading system, a Fico score, if you hear about that. And that Fico score can range anywhere from usually 350 to 800. Not yet.
Sorry.
That's okay. So 350 to 800 is, for the most part, the range, though the 3 different reporting agencies have different scales, but that's basically the range. It's important to know the makeup of your Fico score. So you'll see the biggest input or the biggest portion is based on your payment history. 35%, over a third of your Fico score is based on that 35%. Are you paying, have you been paying your credit card bills, your debts, your utility bills, everything on time, or are you late? How often are you late? Are you 30 days late? Are you 60 days late? So your payment history is very, very important. So pay attention, don't be late. Also, how much you owe on credit cards and debt in general. That's the next in line as far as the weight that they put on it. They want to make sure you're not overspending. They will have an idea of your income. You file a request a credit card or a loan, you have to put your income, and then they're going to compare it to how much you owe. And within that FICO score, and there's got to be, you know, a reasonable, not a balance, but it's got to be within reason what you're borrowing. 15% is the length of your credit history. Unfortunately, if you're just starting out now, you don't have much of a credit history, so not a lot of time. But as you go on and establish your credit, that is going to improve, and that's going to make a nice little impact on your credit rating or your FICO score. New credit accounts is 10%, and that's, did you just go out and try to get a store credit card and this credit card and that credit card and a loan? You're just going hog wild right now. So they're going to take that into consideration, how many new credit accounts you've recently opened, and then the types of credit. Again, that goes back to the good credit, bad credit. That weighs into that FICO score. Now we're going to take a look at how that FICO score is used and actually impacts you. So the higher the score, and I said typically the higher end is 800 or so, higher score will get you lower interest rates on any money that you borrow or credit cards, basically, that you're going to borrow from. So look at this example. Somebody has a FICO score of 730. That's a very high score. That's a nice score. That would be considered a super prime. Because they have such good FICO score, they are offered a loan. APR, or annual percentage rate, or interest rate, is 3.5%. If they're, say, this is a 5-year loan, their monthly payment is going to be $564 every month. Total cost at the end of those 5 years, so it's what they paid for the car plus the 3.5% interest on everything, is $37,800. If, however, they have a poor FICO score, a lower FICO score, they're going to have a higher interest rate. That's the only way they're going to get any type of a loan. Look at the difference. So a 525 FICO score, they're getting a 15% interest rate. Their monthly payment is $737 a month, for a total cost of, at the end of those 5 years, of $48,200. Who would you rather be, 730 score or 525? Because with the 525 score, you're paying an extra $10,400 for the exact same car, same period of time that you're paying on it. But because of the interest rate you're getting, because you have a bad FICO score, bad credit history, you're paying a significant amount more. Here we can take a look at it from kind of a different perspective. So I already did the car loan, so we're going to ignore that side, the right side. The left side is a mortgage. Mortgages typically are for 30 years, so a 30-year fixed rate loan. And let's say you borrow $250,000 for that house on that mortgage. You are an exceptional borrower. You are a super prime. You have an 800 plus credit score. Kudos to you. You're going to be offered a very low interest rate on your mortgage, 3.73% in this example. The total you're going to pay in interest after those 30 years is $166,000 and change. That is on top of the $250,000 you're paying for the mortgage itself. So you're repaying that loan at $250,000 and you're paying an additional $166,000 in interest. Now, if we go down to the orange circle, that is a 580 score to 669. That is a very low FICO score. And because of that, you're considered a risk. You're a risky borrower. So you're going to be approved, but at a high interest rate. Now, 5.33 doesn't sound like much different from a 3.73. Doesn't sound that significant. However, over 30 years, on a large amount like $250,000, the interest paid is $251,000 and change. Same loan, you're getting the same $250,000 borrowing, same term, 30 years, but you're paying about $85,000 overall additional in interest because you have bad credit. Now, if you're even worse at 579 or less, that is definitely a subprime, and you're not even going to qualify for a mortgage. They're going to say, no way, too risky, you can't even get it. So this shows you how impactful it is to have a high versus a low FICO score. So this I added because my son came to me a few weeks ago. He got his first credit card. Kyle came to me after he first used it. He'd had it for a few months, finally used it, came to me about a week after he used it, said, Mom, now what do I do? How do I pay? What do I do? How much do I have to pay? How do I even know what I used? And I told him, hold off. He hadn't even gotten the statement yet. So kudos to him for being proactive. But this is a sample credit card statement. And if you don't have a credit card yet, you're not familiar with it. So I want to just kind of show you the ropes just a little bit. So once you've gotten that credit, and depends on what interest rate you get, how much you're going to have to pay and all that. But this is a sample statement. On it, you're going to see an account summary. And it's the basics of, your account, what happened over the last month, any fees that were charged, what you paid last month, things like that. All of that is in the account summary. Then there's payment information. This is your new balance, and this is the top right, new balance, and the minimum payment due. The minimum payment due looks like a wonderful thing. It's such a small number as compared to the balance. Credit card companies love to do that. They lure you into just paying the minimum because you're paying interest on the rest of it. So they like that. If you don't pay it all right now, that's fine with them. They're peachy keen, happy as can be, because they're going to get a lot of money from you in interest. And then it also has the payment due date, which is typically 3 weeks to 4 weeks from the date you receive your statement. I cannot stress enough how important it is to pay by that due date, especially now if you're paying online, which many people do now. Most people do, I think, especially young people. Pay it a couple of days in advance. Who knows if your payment due date is going to end up on a holiday, and just to be on the safe side, don't risk paying it late. Pay it a couple days early. The third thing you'll see is a late payment warning. If you don't pay by that payment due date, this is what the fee is going to be. So you have fees. As I mentioned before, there are fees associated with credit cards, one of them being a late payment fee. You never want to pay those. Those can be $35, which, boy, those add up quickly. And then number 4 is a minimum payment due warning. And on the next slide, when we get to it, I'm going to go into this and give you an example. But what they are now required to do, because people were getting so far into debt and not realizing, as I mentioned, that very, very first slide I talked about, how people don't realize how long it's going to take to pay off a credit card. Now they're required to show you. And in what Jeremy just circled, if you only pay the minimum amount, how long it's going to take you to pay off that credit card balance, and what the total is that you're going to end up paying on it, which would be the principal, what you borrowed, plus all of the interest. Then they will give you another example, and it will be paying the minimum payment with additional money. If you pay a larger amount than you're required to, then it's going to take this many years, and this is the total amount you're going to end up paying, and this is how much you will end up saving because you pay it early. The last thing I want to point out very quickly is this account activity, and this is what Jeremy was referring to. This is a perfect way for you to take a look at what you're spending every month, come up with that spending plan. It will show you what you pay, what you bought, what day you bought it, where you bought it, and how much you paid for it. It's important to keep tabs on this. I would come back to this periodically. Every time you get a credit card statement, you should look at it closely. We know how much fraud is out there now, and I can't tell you how many times I've looked at my credit card bill and seen charges that I did not make. Somebody had access to my credit card number. Somebody was out there just putting random numbers in. They were able to access my credit account and charge things. Thankfully, if you dispute them, the credit card companies are usually very good about giving you back that money. They do not make you liable when somebody else takes over your credit card, and it happens all too often. Both my husband and I, just in the last month and a half, had it both happen to both of our accounts. And what they did was they issued new credit cards and just excused those charges that we didn't make. So make sure you check it periodically. Well, check it every month you get it, but stay on top and then periodically update your spending plan. And here we go. So I was talking about making that minimum payment, and this is where you can actually see it in play. So let's say you put $2,500 on your credit card. Obviously, you don't have the best credit history or FICO score because your APR or interest rate is 18%. If you make the minimum payment required, heck, it's probably something silly like, $50, $25. I don't even know what it would be exactly, but they tell you can make a minimum payment. You're going to have to make 123 monthly payments, which is going to take you 10 years to pay off. That's if you don't charge another thing on it. Your total payments is going to be over $3,900 when you only charge $2,500 initially. You're going to pay over $1,400 in interest over those 10 years. If, however, you say, well, I'm going to pay the minimum payment plus $25 each month, you're going to drop the total number of monthly payments to 50. So you'll pay it off in 4 years, and the total is $3,258. Even better, you say, I'm going to make that monthly payment and I'm going to pay an additional $50 every month. You're going to go from 123 monthly payments to only 33. It's going to take you less than 3 years to pay that off for a total of $2,839. So you would have paid $339 in interest if you pay $50 extra each month versus over $1,400 if you take the full time, 10 years, and pay the minimum payment. Now, ideally, I'm going to throw this out there. It might not be as feasible if you did have this kind of a balance, $2,500 at your young age. If you got that, had that $2,500, 18% interest, but you said, I'm going to pay the whole $2,500 off my first month, total monthly payments is going to be 1/12 of a year to pay off, and your total payments will only be the $2,500. You're not charged any interest until after you're charged that first credit card billing date. So you charge $2,500. If you pay it off on the day your payment is due, so you're not paying the minimum payment, you're paying the full amount. They don't charge you any interest, not a penny. So ideally, that's what you do. You charge only what you can pay off right away. So I'm not saying credit cards are bad by any stretch of the imagination. We've already said they actually are kind of important and very useful, but there are 6 ways that you should use them wisely. First, charge small amounts, like I just said. Pay off the entire balance each month if you can. It's not always possible, but try to carry as low a balance as you possibly can, because again, you're paying interest on that balance each month. So keep those charges small if you can. Don't make late payments. Late payments go on that credit report. That credit report is how your FICO score is calculated. That makes a huge impact in all of this, your interest rate, your loan amount, all of that. This sounds a little strange, request lower credit limits, but if you don't have good self-discipline, sometimes they'll come at you and they might say, we're going to give you a credit card with $5,000 limit on it. You're all excited, great. Well, maybe you don't have the self-discipline to not spend $5,000 on things you don't need just because that $5,000 is available to you. You may want to contact the credit card company and say, look, appreciate it, but I'd really feel more comfortable if you lowered it to $1,000. Now you've got $1,000. They're always willing to up it, but they might bring it down for you. You're not as likely to spend. You're not going to spend $5,000, even if you max it to $1,000, which I hope you don't. That's a much lower number, much better off. One thing we'll also say is about contacting the credit card company. If you start out now, you get a credit card, it's a high interest rate because you are young, you don't have a nice, lengthy credit history, but you get the credit card, you use it, you're charging small amounts, paying it off each month, you're doing what's right. That's going to improve your credit score very quickly. 6 months later, I believe is the time, you can contact the credit card company and say, hey, I would like you to reconsider my interest rate. Check my credit report now, and they may very well reduce or lower your interest rate. So once you get your credit established, you can start getting those lower interest rates. Do not max out your cards. You know, you get in over your head. Don't overspend. Choose one card. It is too easy if you have multiple cards out there, too easy to put money on each and every one of them, which is going to, each one will require a minimum amount. And it's just a way for it to get really out of control. And then lastly, never accept cash advances. Cash advances sound wonderful, but they really aren't. There's so many negatives to them. Never use a credit card for cash. On top of, just having to pay interest and everything on it, there are very high fees associated with cash advances. So avoid that at all costs. Last thing I want to touch on with credit is understand the gimmicks. They're not all bad, but credit card companies will try to entice you in to use their credit card, get more and more credit cards. So they might offer rewards, miles, cash back, points, donations. Not a bad thing. I have credit cards with miles and cash back myself, but I use them wisely. I don't charge things. I don't put things on my credit card just to get the miles or the cash back. And I make sure I pay every month. So it's not a bad thing to have rewards, but don't use your credit card just to run up those miles or to get extra cash back. Still live within your means. They'll offer freebies, t-shirts, music, gift cards, kind of big deal. Don't fall into that trap. Store cards, you go into your wherever, Abercrombie, Marshalls, whatever it might be. You go to check out and they say, oh, if you, get a credit card, open a card with us right now, we will give you 5% off your purchase today. Not a great thing. Store cards tend to have very, very high interest rates. So while they might look good, and you're excited, you're getting 5% off right off the bat, but then once you start charging, and if you carry any debt on that, you're going to pay high interest rates. Beware pre-approved offers. Make sure you read the fine print. Cash advances, I already told you about that. The fees involved in that, stay away. Don't listen to that. And then promotional interest rates. You might get something that says, hey, 6 months, no interest. Sounds great. You go out and you're going to charge to the max because you don't have to pay anything on it. But once that 6 months is up, that interest rate is going to just jump right up and you're going to be stuck. So stay away from those with promotional interest rates, or at least be wise about it. Make sure you're paying on it, and ideally you pay it off before those interest rates jump up, because they will. And one little statistic again, seniors graduating from college acquire an average of $4,000 in credit card debt spread across at least 2 cards by the time they're out of school. $4,000 is a pretty significant amount on a credit card. Just starting out, there's bad thing number 1. Number 2, 2 credit cards. I just said on the last slide, stick with 1 credit card. Keep it all in one place. That will help you avoid overspending like that $4,000 credit card debt the average student has. So now that we've taken care of establishing your credit, you've got your credit card or whatever it might be, your FICO score, and you're getting wise about that. You have your spending plan in place. Now we'll move on to saving and investing. So jump to the next slide. Okay, saving and investing. So this is where it's very different from what we've been talking about credit. Credit, you're borrowing money. So you're getting money from somebody else, someplace else, and you're paying interest for that money. So you're borrowing and you pay interest. When you are saving and investing, it's your money, you're gaining interest, you're earning interest on that. You can have savings, like a savings account, money market account, checking account. These are typically things you're going to find at a bank. And then you have the other side, which is investments, bonds, stocks, mutual funds, real estate, commodities, that type of a thing. Now, Jeremy and I are going to be putting together more of these webinars, and we plan on having one, investing 101. I don't know what we'll call it yet, but something along those lines that's going to take a deeper dive into savings versus investments and the type of investments that can be pretty safe and earn you a low interest rate, and those that you take a little more risk, a little more chances, and you get a little bit higher payout ideally on them. But we're not going to get into that now. I just want to point that out for a few minutes from now when I'm talking about compounding. But stay tuned. We will have more webinars coming your way. Okay, question for you. Would you rather double a penny every day for 31 days or receive $1 million? So if I said, I'm going to give you $1 million today, or I'm going to give you a penny today, tomorrow I will double it. The next day I'm going to double that. So you get a penny, then 2 pennies, then 4 pennies. Which would you rather? And drum roll. Yeah, I know. I was going to do that, but I figured drum roll is better. I don't want you don't want to hear me do that. Look at this. This is because of the power of compounding. Day 1, I gave you a penny, doubled it, doubled it, doubled it. Look at day 31. You would have $10,737,418, which seems crazy, but that is the power of compounding. Now I'm going to show you in the next video a slide, I guess, a quick video that's going to explain the power of compounding. We're going to swap sharing screens. It's a very quick video. We just figure out how to share. Okay, here we go. Share my screen. Here we go. You can see this, right?
Yep.
Okay.
Compound interest is the interest an investor earns on his original investment, plus all the interest earned on the interest that has accumulated over time. It is easier to think of compound interest as interest on interest. To understand compound interest, let's first look at simple interest, the interest earned on the original principal only. Suppose you deposit $10,000 into a high interest savings account at a 5% simple interest rate for 3 years. The interest you earn each year is 5% times 10,000, which equals $500, for a total of $1,500 of interest at the end of year 3. $500 plus 500 plus 500. Now instead, suppose that you deposit the same $10,000 at 5% interest compounded annually. In year 1, the interest you earn is the same, $500. But in year 2, the interest you earn is 5% times 10,500, the original amount plus the interest you earned in year 1. So the second year's interest is $525. In year 3, you earn 5% interest on $11,025. $10,000 plus 500 year 1 interest plus 525 year 2 interest, or an interest payment of $551.25. In total, you earn $1,576.25 in interest over 3 years with compounding interest versus $1,500 with simple interest, a difference of $76.25. The effect of compounding becomes especially powerful over longer time periods as the amount of earned interest becomes larger and larger.
Okay.
All right, let me flip back. We laugh about that $76, but the last point is
Compound interest is what we're talking about.
Wait,
It's a mathematical.
Didn't want that to happen.
Yeah.
Another video started. YouTube just kept going. Yeah. Jeremy was just saying that doesn't sound like a lot, $76.25 being the difference. But as the very end of that video showed, the further out you go, the more compounding makes an impact, a difference. And we're going to see that in just a moment with another slide. So this is a way to look at your investment rate as well. So this is all based on compounding and how quickly your money grows. This is called the rule of 72. With the rule of 72, you take 72, divide it by the interest rate you're earning, and that will be the number of years it takes for your money to double. So it's a formula to figure out how long it will take for your money to double at a certain investment rate. So the first one, 72 divided by a 1% interest rate or investment rate, it's going to take you 72 years for your money to double. Makes sense? Now, if we go down to say an 8% interest rate, which you may very well get if you with your investment portfolio, depending on how you're invested and how the markets do, 72 divided by 8% is 9 years. So it's going to only take you 9 years. Oh, I don't know if they know long division anymore.
Yeah, I don't even know if that's
hopefully you young people do understand long division. I love long division, nerd that I am. So anyhow, it would take you 9 years to double your money at an 8% interest rate. And that's the power of compounding. So the higher the interest rate you're getting, the fewer years, obviously, you're going to need to double your money. Now we're going to take a look at that from another perspective, showing you 3 different interest rates. And I said that in a future webinar, we're going to have like an investing 101. This portfolio, 3%, 6%, 9%. I'm just going to toss out there that one investment type is going to give you 3%. That's a very cautious investment, and a little more aggressive or risky on that far end, it's going to be 9%. So as you go up in the risk, the greater percentage or possibility that you're going to earn on your money. Same thing, 72 divided by your interest rate. So all 3 of these scenarios, we're investing $10,000. So the first one, 72 divided by 3%, your money is going to double in 24 years. So at the end of 24 years, you're going to have $20,000. Now, if you're at 6%, 72 divided by 6, your money is going to double in 12 years. And then it's going to double again in another 12 years. So you're going to have 40,000 at the end of 24 years. Now you're at the 9%. You're, a little invested a little riskier, but your payout's a little bit better. 72 divided by 9% interest rate, your money's going to double in 8 years, and again in another 8 years, and again in another 8 years. So at the end of 24 years, you're going to have $80,000. Pretty significant difference, but that's all due to the power of compounding. Okay. And one more when we're talking about compound interest, but this is also, Jerry was talking about earlier, starting early. And if we start early, let's say you're 20 years old, you start contributing $5,000 a year to an investment account. Your investment return, we're going to just say is 8%. If you're investing and you don't touch it until you're at retirement age, so the entire time, so for 45 years, you're putting in $5,000 a year and an 8% return, you're going to walk away at age 65 with almost $2.1 million. If, however, you wait until you're age 25, you are going to do the same $5,000 a year, but for 5 years less. So you're going to miss out on 5 years of you contributing $5,000, but also that compounding for those 5 years. So 25 at $5,000 at 8%, you're going to walk away at 65 with a still very impressive $1.4 million. But those 5 years made a difference of $688,225 in what you would have earned, what your portfolio growth would have been. I also like to point out on this side that you're never too late to start investing. Now, this only goes to age 35, but even if you're 35 years old and you start investing $5,000 a year at 8%, you're still at age 65 going to have almost $612,000 saved. So it's never too late to start saving, but the earlier you save or start saving due to compounding, the more you're going to make, the much better off you're going to be.
Great point, Deb. Like we talked about earlier, all the people say they wish they'd started 20 years earlier. Here you go. This is why. And we'll get into a little bit more detail about that too.
Exactly.
Thanks so much, Deb. So Albert Einstein called compounding the 8th wonder of the world. And it's easy to see why. We spend so many years working for our money. It's a great thing when we reach the point where our money starts to work for us. And we want to reach that point in life, again, as early as possible. So that compounding that Deb talked about can really work its magic. So now let's look at some ways to help accelerate that compounding process. So the first is to save a little bit of each raise you get over your lifetime. Whether you haven't started working yet, or if you're already working, in part of the workforce, it's important to realize over time that you're likely going to make more money, a little bit more and a little bit more as you build your career. Again, going back to the spending plan exercise, we have some choice as to what we do with the additional money that we make. We can spend it all without giving it a second thought, or we can put a little bit of it in our savings and we can spend the rest. So that way we get to enjoy some of it now, and we put some of it to work so it can work for us and be able to enjoy it later on. Our suggestion is to save 30 to 50% of each raise. So what that means is if your raise was $100, they paid you an extra $100 going forward. If you saved 50%, that would mean you would take $50 and put it into your savings, and you would spend the other 50. Here's an example of somebody who does just that. There's an example of somebody who saves the same amount each year, okay? And then there's an example of somebody who saves half of each of their raises. So the person who saves the same amount at the end of the day, when they get to their retirement, and this is based on saving $5,000 a year, again, plus versus saving $5,000 plus the 50%. So the person who just saves the same amount each year, they end up with about $1 million. Again, maybe not bad, but if they just save half of their raises over time, now they're at $1.4 million. So that's $400,000. That's 40% more in what they have. That's a big difference. But it means you have to be disciplined and you have to stick to your plan. So hopefully being aware of these little differences will help you with that from a young age. Now we're going to talk about one of the most common and powerful ways to save money as you begin those working years. Most people at some point are going to work for a company that offers a 401k plan. A 401k plan is a place where you can save money and you can defer those taxes that we talked about in the beginning. And remember, when you make money in this country, you have to pay a little bit to Uncle Sam in the form of taxes, which means you get less in your pocket. So with the 401k plan, it allows you to save some of your money without paying that tax for the moment. So more of your money is going into savings. Then, due to the power of compounding, it'll grow over a long period of time. And when you retire and you're ready to use the money, you pay the taxes at that point. But for all those years, you got to keep that money working for you and earning interest with no taxes. Even better, most employers give you what they call a match, meaning if you put some money in, they will put some money in too, and that's called a match, and it helps your savings grow even faster. But they usually only do this if you're going to put in some of your own money. So let's take a closer look. In this example, we earned $100, and we have a choice as to what we're going to do with it. On the left side, we can see what happens if we choose to take it all in our paycheck. So we start with $100, right? But after we pay those three major taxes, we end up with only about $72 left to spend. Started with 100, we ended with 72. Now, on the right-hand side, if we decided, instead of taking that money in our paycheck to spend, if we decided to put it in our 401k plan, we don't pay any taxes right now at all. And our employer matches that $100 with another $100. So we end up with $200 in our savings instead of just the $72. So we doubled our money right off the bat, and now that money can compound until we're ready to use it. Another way to look at this is that 401k match is like free money. So we meet people all the time who aren't even saving the minimum amount to get the match in a 401k plan. And it's really a shame because, again, it's like throwing away free money. This picture just shows the idea of what your retirement looks like, depending on your choices. So, not saving for retirement versus saving in a 401k versus all the big hypothetical green dollar signs. Obviously saving and getting that match. Finally, here's a great picture to summarize really everything that we've talked about today. So here we see 4 different people who all save the exact same amount each year. In this example, they're saving $12,000 a year or $1,000 a month. Now, that might sound like a huge amount of money today, but two things are important here. One is this number is just an example. So like we talked about, it's important to have your own spending plan and a saving plan that you put away whatever you're able to based on your own situation. And two, that you have this knowledge so you can start early and build a little as you go. Again, there's nothing wrong with starting later. We want you to start when you have the opportunity to do these important things. So don't be discouraged, but the earlier you start, the better it's going to help you later on. In this example, Alyssa starts saving her money at age 20. Over her working years until she's 65, she puts away a total of $540,000. Now, Matt starts 10 years later at age 30. Okay, he's putting again the same amount of money away each year, but because he doesn't have as many years to put it away, he only puts away, oops, I kind of messed that up. He only puts away about $420,000. Then Deborah, another 10 years later, okay.
I didn't create this slide, by the way. If I had created it, I would have been Alyssa. Or I would have wanted to be Alyssa.
Nice. So Deborah, not current Deborah on the presentation, she starts a little later at 40. She can only save the 300,000. And then again, finally, James, he's starting a little bit later at 50 years old. So he's only able to put away, even though he's saving the same $1,000 a month, he only gets 180,000 put in by the time he retires. So when they get to retirement, what do each of them have? Well, they all put the same amount of money away each year again, and they all retired the same age. But because Alyssa started early, she earned over $2 million from compounding alone, which Deb just talked about. So when she gets to her golden years, she's going to start with a whopping $2.7 million. Okay. Now, again, Matt started just 10 years later. He put the same amount of money away each year, and he still has $1.4 million, but still, that's really half of what Alyssa has. All right. And again, Deborah did a great job saving after 40, but because she started a little bit later, she only has about $700,000. Finally, James, his parents didn't bring him to a workshop like this, and he didn't start saving until so late that he only has about $300,000 left for his retirement. And, it just means he's probably not going to be able to enjoy the same lifestyle as others. And it probably won't even be what he had hoped for all those years that he worked really hard. So another way to look at this is while Alyssa only has to save the $12,000, right? Another way to look at it is Matt would have had to save $36,000 per year instead of $12,000 to get to the same number as Alyssa. Deborah would have had to save $80,000 per year. Again, we're just talking about to reach the same $2.7 million that Alyssa has at retirement. And then our friend James would have had to save $160,000 per year for those last 15 years that he worked, which, frankly, may be impossible. So hopefully the message here is clear. If you just start saving early, you let your money work for you like Deb talked about, even though it means not buying everything you want right now. Your money will work hard for you, and you'll be able to spend and enjoy that money a lot more in the future.
Before we finish up here and go to key takeaways, we do have a question from Rachel.
Oh, great.
When you talk about this compound interest slide, is there a specific investment type we should put that 5K into each year, or does it really depend on several factors? Yes, it does. How you invest, the riskier you invest, the better return you're going to get. And no matter what, you're going to have the compounding interest. But if you're going to be receiving a lower interest rate because you're more conservative or taking the safe approach, where you're not going to earn as much on your money interest-wise, you won't have as much compounding. If you invest a little more risky, and this is again in the Investment 101 session we're going to be doing, the riskier investments, stocks, can pay much more than that. You're going to get a much higher interest rate on average over those 45 years. So it's an average of 8%, I think we were looking at in that slide. I'm just looking now. In 2016, the average return for a portfolio was 60% stocks, 40% fixed income. it's called a balanced portfolio, was 8.7. So you would have received about 8.7 on average over those years, and it would get you right where we were talking about in the slides. More recently, however, the stock market has done really quite well. Do we expect it to continue like this? Not likely. We will have ups, we will have downs. Historically, that's what we do. We have cycles, but right now they're saying that a 60-40 or 60% stocks, 40% in fixed income portfolio is averaging over 10% a year. So yes, it does depend on how you invest as far as what interest rate you can expect to receive in the long run. And it's an average that we're looking at there. So stay tuned. We will talk about that in much more depth at that investment 101. But again, the younger you are, the more risk you can typically take if you're looking at a retirement account. But that's for our next seminar.
Yeah, can I just add one thing to that too, Deb? Great job explaining that, but just one thing that comes to mind is the sooner that you're going to need or want to use that money, the safer you need to be. And that generally means that you're going to earn less. Whereas like Deb said, if this is retirement money or some goal that you have that's many years down the road, then you can use some of those vehicles that might earn a little bit more, but there's risk that comes along with that too. What we don't want to have happen is we certainly want to promote the idea of saving and putting money away into different types of savings and investments so that you can prepare for the future. But we also want people to remember that it's not good to put everything into investments that have risk, because you may need some of that money in the short run, and we don't want the market to go down and take it away from you. So again, really a topic for our next discussion, but appreciate the question and thanks, Deb.
Yes, and there are no guarantees when it comes to investing. We always have to have that disclaimer out there. So just because we've had great performance the last few years, it's no guarantee we're going to have that moving forward. But we do know from history how things go. So key takeaways, what we're hoping that you're going to walk away with from here is one, know where your money's going, get that spending plan together, get your budget, whatever it might be. Make sure you know where it's going. Look at your credit card statement or your bank or your apps, whatever you have an idea. Find out where you're wasting money. Maybe stop wasting that money. 2, pay off your credit cards on time. Again, I can't stress enough how important that is. It will impact your credit report, your credit rating, which influences so many other aspects of your life, whether it's, purchasing a house, getting a loan, getting a job, getting that cell phone plan that you're going to need in a few years. So pay those off on time. And then why not set a goal to save 15% of everything you earn? If you were to do that, put it away, like set it and forget it. You won't even notice that you're doing that. You get used to it. You're going to take advantage of starting young. You're going to take advantage of that compounding, and you will really see your money grow.
Yeah, absolutely. And I just firmly believe, and I told my daughter this recently, she'll be 16 in another couple of months, is if you just follow these 3 things, truly, if you stick to this and you do it for the rest of your life, you will in all likelihood never have to worry about money under normal circumstances for the rest of your life. Because as you reach these different stages and milestones in life, you will have already been preparing along the way. And then it's also it's encouraging once you're doing these things to see the success that you have and how it's working. And then you want to do more. So these are habits that kind of build on themselves. So again, we just want you to get started right out of the gate with some good habits, rather than having to dig yourself out of a hole like many people do some years down the road. Yeah,
exactly.
And to have additional help with these subjects, and again, we certainly appreciate you coming here, but some of the things that we talked about, those different apps for budgeting, Mint is probably one of the most common. There are some online calculators for compounding. And this, I guess, if you're a finance nerd like us, can be fun. So you can sit back and say, well, how much, if I save this much and I earn this interest rate over this many years, how much do I have versus this many years? And what if I earn a little bit more? And you can play around with those online calculators called future value calculators or time value of money calculators. And those are again, really encouraging to help with savings habits. When you check your credit, the best place, in our opinion, to do this is annualcreditreport.com. So Deb talked about the 3 credit reporting agencies, TransUnion, Equifax, and Experian. annualcreditreport.com is the only website. It's a government sponsored website. It's the only one that gives you access to all three of those for free every year without having to pay any sort of hidden fee or sign up for a subscription or anything like that. You can access them each one periodically, but annualcreditreport.com, not Free Credit Report or any of these others. And then there is Credit Karma is another one, which is popular for managing those sorts of things, but I believe there's a subscription fee. So those are some kind of technical resources, but really think about what you have close to home. Talk to your parents, talk to other people who are maybe a little bit older than you. Frankly, I would, as a general rule, suggest maybe your friends aren't the best source of this information for now. Talk to your parents, talk to your parents' financial advisor, whatever it might be. But just if you have questions, ask. It's much better to be talking about these things than to not talk about them. So, we really hope that you have enjoyed this. I guess we can stop the sharing here. Hope you enjoyed this presentation. Really hope it's been helpful for you.
Absolutely. And what I would say is not using your friends as a resource. Hopefully now you can be a resource to your friends. And if you have any friends, family members, whomever that would be interested in watching this, or if you want to take a look at it again, we're going to be posting the replay on our website, www.potomacfinancialgroup.com. And it's also going to be available on YouTube. So again, as Jeremy said, we really appreciate you joining us. Thank you so much. Stay tuned for more webinars down the road. And again, if you want to view the replays, it'll be available in the 2 different places.
Great. Thanks again, Deb.
Thank you.
Talk to you soon. Thank you all. Take care. Till
Have a
next
great
time.
night. Bye-bye.